Shares of the Gap, or GPS, are trading at $28.96, and they are up over 28% after its May 31st close, and it looks like it's still going up in after-hours trading as well. Zooming out on the chart, you can see this stock has massive price swings and volatility, and has had it for quite some time, having at least 4 huge bull runs since the late 90s. In terms of fundamentals, GPS has smashed all 4 of its last earnings calls. The probability of bankruptcy is the lowest I have ever seen at 1.8%, which is basically as close to zero as you can get. The average one-year analyst price forecast for this stock is $26.11, which is 9.8% lower than where it trades today, with a high estimate of $32 and a low of $9. But I would take this with a grain of salt, as given, a lot of analysts have recently upgraded the stock this last trading session, and that may not be updated to reflect it, and likely isn't. But that all seems great, but there is one main reason that I think you should avoid this stock for the time being, and that is, of course, its valuation. Like so many stocks right now, GPS's price to earnings ratio is 74, which is 67% higher than the sector average of 24.66, and it is also very high given the company's historical numbers. By January 2026, GPS is expected to earn a revenue of $615 million, which works out to $1.65 per share, and if we follow the trend of the price to earnings, I think that we can expect that to fall around 25 at that time, which would result in a share price of $41.33, which is a 43% upside. Again, that would be for January of 2026. They do also have a nice dividend at 2.07% yield right now. But again, the main thing that concerns me is just that valuation. Historically, the gap has traded closer to 10, and just having that over 70, again, that's the PE we're talking about, a PE over 70, it just has so much room to fall from there, should there be any negative news between here and 2026. But I don't think it would be unreasonable for the gap to hold a PE over 25 for that time. So if you believe in their earnings projections and you believe in the company in general, then I don't think it would be a bad investment. But for me personally, there's just too much downside risk given the high valuation right now, even with the 43% upside potential. Anyways, that's all I have for you today on GPS. Please drop a like, leave a comment, and I will see you next video.